You know that feeling, that sense of just being completely overwhelmed when you start looking into investing.
Oh, yeah, it's like this wall of information, right?
Yeah.
Articles, tips, charts all over the place.
Exactly. And you're constantly wondering, am I missing something really basic, something, fundamental?
It's a common feeling. The financial world can seem deliberately complicated, full of jargon. It's hard to know who to trust or where to even start.
Absolutely. And well, that's precisely why we're doing something a bit different today on the channel. A special book talk.
Mm-hmm.
We're diving into a book that really aims to cut through all that noise. It gets down to the underlying principles, sort of the scientific basis of how investing actually works.
And the book is The Four Pillars of Investing.
Hmm.
The author is, well, he's got deep expertise, but also this knack for breaking down really complex stuff into something you can actually grasp and use.
Yes. And that's our goal for you today. We've spent time with this book, pulling out the core ideas, the really essential knowledge.
The things that can genuinely help you become a more informed, maybe more successful investor.
Think of this as getting you clued into the bedrock beneath all that market chaos and noise.
That's the idea. And the author kicks things off with a point that might actually surprise a lot of people, maybe even some working in finance,
Which is?
that there is a scientific basis to investing. It exists. But it's often just ignored. Or maybe people just don't know about it.
Right, and understanding that science is what the book is all about. It's structured around these four pillars.
Exactly. Theory, history, psychology, and business. The author argues that these are the four absolute essentials you need to understand.
Get a handle on these, and you've got a solid foundation for making smarter decisions.
Okay, so let's dig into that first pillar then. Theory. What's the absolute core concept here?
Well, it really boils down to risk and return. That's the bedrock.
Mm-hmm.
The book just hammers this home. They always go together. You can't separate them. If you want the chance of a high return, you have to accept significant risk.
So if you see a stock or a market that's like doubled really fast.
Yep. The book says it's just as likely to get cut in half just as quickly. That potential works both ways.
And this pillar theory, it also includes that that really pointed observation about brokers, doesn't it? Almost cynical, but insightful.
Oh, absolutely. If your broker really knew, like guaranteed knew, a stock was going to shoot to the moon.
They wouldn't be calling you.
No way. They'd quit, they'd mortgage their house, borrow from everyone they know, pile into that stock themselves, and, disappear onto a yacht somewhere. They wouldn't tell a soul.
It's a blunt way to put it, but it makes the point, right? They're selling. They don't have some secret crystal ball just for you. If they did, they'd use it themselves.
So what are the key takeaways from this theory pillar for an investor, for you listening?
Well, the book suggests measuring probable returns isn't like impossible rocket science, but even the experts get it wrong. A lot.
And here's a big one. Those differences you see in performance between different money managers. Over time, it's mostly luck, not skill. You don't actually get rewarded for trying to pick the star manager or the next hot stock. The odds are stacked against that.
Which leads right into what the book calls the biggest risk for most people.
And it's not picking one bad stock.
No, it's failing to diversify properly, putting all your eggs, or too many eggs, in one or two baskets. That's where the real danger of catastrophic loss lies.
So it's not about individual winners, it's about the whole picture.
Exactly. It's the portfolio as a whole that matters, how all the different pieces work together. That's where portfolio theory comes in. It's the science of blending assets to manage that overall risk and aim for the return you need, make the whole thing work together predictably.
Okay, that makes sense. And that idea that individual parts are unpredictable but the whole matters, that leads us nicely into pillar 2, history.
Right. And the book makes a really strong case here. Finance isn't like physics, a hard science. It's a social science. Meaning, a bridge built today follows the same physical laws as one built 100 years ago. But financial markets, they're driven by people, by changing rules, changing contexts. They behave differently over time.
And that's why the author says if you don't know financial history, you're, quote, irretrievably handicapped.
Yeah, history gives you context that just looking at numbers or theories alone can't provide.
What kind of context are we talking about?
Well, for one, just how long financial history is. We've had credit markets since, like, ancient Mesopotamia. Government bonds have been around for centuries. That long view helps put today's ups and downs in perspective.
And history definitely shows us that markets go to extremes, doesn't it?
Oh, absolutely. The book calls it psychotically euphoric in booms and toxically depressed in busts. And the message is clear. You are almost certainly going to live through both kinds of markets, probably more than once.
History also points out that all this modern investment tech, while useful, also creates new kinds of risks we didn't have before.
Definitely. The examples in the book are great. You see these charts of European interest rates way back from 1200 to 1800.
Wow, that far back.
Yeah. And you see how things like wars or plagues made borrowing incredibly expensive. Then you see English government bond rates, consols swinging wildly in the 20th century. Even safe government debt isn't always stable.
And big shifts, like abandoning the gold standard.
It completely changed the game for stocks versus bonds. Took investors ages to figure out the new reality.
The book also details all those historical bubbles, right? The manias.
Tulips, the South Sea bubble, the tronics boom in the 60s, conglomerates, the dot-com era. History just screams that these things happen again and again.
Usually fueled by some exciting new thing, cheap money, and everyone forgetting the last crash.
Pretty much, yeah. And the flip side, too, market bottoms. Remember the death of equities headlines in the late 70s. Stocks were dirt cheap, but nobody wanted them.
So the conventional wisdom at the peaks and troughs is usually wrong.
Almost always, according to history. Which brings us perfectly to Pillar 3, psychology.
Okay, so if history shows what happens, psychology tries to explain why we keep doing it.
Exactly. The book calls our human nature in markets a deadly quicksand of maladaptive behavior. Our own instincts often lead us astray.
So what are these psychological traps you need to watch out for?
Well, becoming way too confident is a big one, thinking you've got it all figured out. Systematically paying too much for popular stocks, the ones everyone's excited about, trading way too much, churning your account, and racking up costs.
And just making emotional decisions. Buying when you feel euphoric, selling when you feel panicked.
Precisely. This is where behavioral finance comes in. Kahneman, Tversky, Thaler, the Nobel Prize winners, they've shown how powerful things like herd behavior are.
We just want to follow the crowd.
We're wired for it. Even if the crowd is heading off a cliff, investment ideas become fashionable, just like clothes.
And overconfidence seems like a really central problem.
Huge. We think we can pick the winning stock, we can time the market perfectly, even though professionals struggle. The author has this funny, kind of dark fantasy about giving analysts truth serum.
What would they say?
He imagines them admitting, honestly, I have no clue where the market's going tomorrow, but my job depends on me sounding confident, so that's what I do. People want certainty, even if it's fake.
Then there's recency bias.
Oh, that's a killer. We put way too much importance on what just happened. Market's been soaring. Let's go up forever. Market crashed. It's broken. Sell everything.
And that blinds us to the long-term picture.
Completely. It blinds us to mean reversion. The tendency for really high returns to be followed by lower ones, and vice versa. Things tend to swing back eventually.
What about the need for excitement?
Yeah, that's another dangerous trait. We're drawn to long shots, low probability but high payoff bets, like the lottery or that super speculative penny stock.
And we fall for the great company equals great stock idea.
All the time. But history often shows the opposite. Those boring, unglamorous companies sometimes deliver better stock returns because expectations are lower and prices don't get bid up to the stratosphere. Superior growth is often already priced in, or just an illusion.
We also see patterns where there are none, right?
Yeah.
Like in random market noise.
Our brains are pattern-matching machines. The book mentions the 1987 crash. People were putting charts of 87 over charts of 1929, seeing these eerie similarities, predicting another Great Depression.
And it didn't happen.
No, it was just noise, but it felt meaningful. It drove a lot of fear and bad decisions.
Okay, so these biases are powerful. How do you fight back? What strategies does the book suggest?
One is to actively identify whatever the current conventional wisdom is. What everyone seems to believe about the market right now, and consciously question it. Assume it might be wrong.
Like the idea today that stocks will always deliver high long-term returns.
That could be an example, yeah. Just question the easy assumptions. Another tip, maybe simpler. Don't talk about your investments publicly.
Keep it private, like dirty linen.
Exactly. It helps shield you from that social pressure, the comparisons, getting swept up in other people's moods.
And just be self-aware. Recognize overconfidence in yourself.
Yeah, ask yourself honestly. Am I really smarter or better informed than the pros on the other side of my trade? The book's answer is almost certainly no.
Which leads us, maybe inevitably, to the final pillar. Pillar 4, business, the investment industry itself.
Right. And here the author pulls no punches. He thinks most individual investors are just touchingly naive about brokers, fund companies.
He even says you were in a financial life and death struggle with the industry. That sounds intense.
It is strong language. But his reasoning is that the industry's core goal is pretty simple, and it's not necessarily aligned with yours. Their goal is to transfer as much of your wealth to their ledger books as they can.
Wow. Okay, let's break that down, starting with brokers.
The key point here is fiduciary responsibility, or rather the lack of it. Unlike your doctor or lawyer, who legally must act in your best interest.
Brokers often don't have that same legal duty.
Generally, no. Their obligation might just be suitability, which is a much lower bar, and their motivation. Often, it's maximizing their income through commissions, fees, getting you to trade more often.
He quotes that chilling old broker saying,
My job is to slowly transfer the client's assets to my own name. Stark, but it reflects that potential conflict.
and they aren't necessarily investment gurus.
They're primarily trained to sell. The pressure to sell, the book argues, creates an ethical anesthesia. An honest broker who tells you to just buy cheap index funds and hold them forever isn't going to make much money.
Okay, what about mutual fund companies?
Their main purpose, the book argues, is gathering assets, getting more money under management, because their fees are usually a percentage of the total assets.
So more assets equals more fees for them, regardless of how the fund actually performs for the investor.
That's the incentive structure, yes. And the book points out that traps load funds with those sales charges, upfront or ongoing. Variable annuities from insurance companies, often layering fees that wipe out any supposed tax benefit.
These are things that are sold, not bought.
Exactly.
Yeah.
Because the benefits often flow more to the seller than the buyer. A load fee, he says, gives you less than nothing. You pay for something that likely hurts your returns.
He uses that example of the Select Technology Fund.
Yeah, investors pile in when it's hot, buying high. Then it crashes, they panic and sell low. The fund company collected fees all the way, though.
Is there any exception to this rather grim picture?
Yes, the book highlights Vanguard, founded by John Bogle. Its unique structure, where the fund shareholders actually own the company, changes everything.
Oh, so.
It aligns their interests with the investors. It drives that focus on low costs, on index funds. It becomes a virtuous cycle. Lower costs attract more assets, which allows costs to go even lower.
And finally, the financial press gets scrutinized too.
Oh, yeah. His take is pretty brutal. 99% of what you read is advertising cloaked as journalism.
Meaning?
He argues journalists often don't grasp the deep academic research. They rely on popular narratives, on industry strategists who have products to push.
There's that confessions of a former mutual funds reporter anecdote.
Right, where they basically admitted they knew pushing hot funds based on recent performance was bad for readers, but it sold magazines. It created churn and excitement.
And he shows examples of how magazine best fund lists often underperform simple index funds over time.
Yeah, like Worth Magazine's lists or even the Forbes Honor Roll. Following that advice often didn't beat just buying the market and holding, especially after costs.
Okay, wow. So we've got theory, risk-return, history, cycles context, psychology or biases, and business industry conflicts. Taking all four pillars together, how does this help you actually build a strategy in a portfolio?
Well, the core lesson doesn't change. Risk and return are linked. If you want growth, you need risky assets like stocks. You can't avoid that.
But you can't reliably predict which specific stock or sector will be the best performer.
Exactly. The pillars strongly suggest that's a losing game. So the prudent path is diversification. Build a core portfolio around the broad market.
Like a total U.S. stock market index fund, maybe tracking the Wilshire 5000?
That's a typical starting point, yeah.
Right.
Then maybe add smaller slices of things like small cap U.S. stocks, large international stocks for more diversification.
What about other things like value stocks or REITs?
They can have a place, potentially. But the book stresses considering your tax situation, your job, maybe you already have a lot of exposure to one sector, and crucially, your tolerance for tracking error.
Tracking error. That's how much your portfolio might differ from the main market index, right? Yeah, either up or down.
Precisely. Some strategies deviate more than others. You need to know if you can handle potentially underperforming the market for periods, even if the goal is long-term outperformance.
What about the safer side? Bonds.
Covered too. Treasuries, corporates, munis. And their risks, interest rates going up hurts bond prices. Companies or cities could default. Diversification through bond funds is usually recommended for corporates and munis. Vanguard gets a mention for muni funds again.
And the book notes that sometimes safety, like treasuries, is expensive. Sometimes it's cheap relative to riskier bonds.
Right, you have to look at the yield spreads.
Okay, shifting to retirement planning, how do the pillars inform that?
The approach is to work backward. Figure out how much income you realistically need in retirement first.
And think in inflation-adjusted terms, that immortal retiree concept.
Yeah, plan as if you might live a very long time and account for rising prices. That forces a more conservative, realistic plan.
This leads into safe withdrawal rates, which can be tricky.
Very tricky. The book makes it clear. A bad run of market returns right after you retire, sequence risk, can devastate your plan.
Yeah.
It dramatically lowers how much you can safely take out each year compared to just using average returns.
So withdrawing a fixed percentage is safer than a fixed dollar amount.
Generally, yes, because it adjusts automatically to market swings. But even with reasonable withdrawal rates, there's always some risk of running out of money.
And the only way to truly lessen that risk.
Be prepared to potentially lower your spending if things go badly. That's the ultimate safety valve. The book also gives you ways to figure out how much you need to save monthly based on your timeline and expected returns.
Okay, so you have a plan. What about actually starting and, importantly, maintaining the portfolio?
The book gives practical steps. You can start simple, maybe with just one or two broad funds, and add more diversification as your assets grow, like the Yvonne example in the book.
It talks about dollar cost averaging, DCA.
Right, investing a fixed amount regularly. Simple, disciplined. It also introduces value averaging, which is a bit more complex, but potentially more powerful.
How does that work?
Instead of a fixed amount, you aim for a target value growth each period. So you automatically invest more when the market's down and your portfolio goes below target, and less, or even sell, when it's up and above target.
Interesting. And the book mentions an advantage you have as an individual.
Yes, a huge one. You only have to manage your own emotions. Fund managers have clients breathing down their necks, demanding action, often at the worst times.
That Rolls-Royce analogy.
Yeah, trying to drive the right way while the owner is screaming at you to do the wrong thing. Individuals just have to master themselves. Hard enough, but simpler.
And a key part of maintenance is rebalancing.
Absolutely crucial. Selling some winners that have grown too large in your portfolio, buying more of the losers that have shrunk to get back to your target percentages.
The book shows examples where this improves returns and lowers risk over time.
It often does, yes, compared to just letting things drift.
Yeah.
But it feels terrible to do.
Selling what's working and buying what's not goes against every instinct.
Totally. But that discipline, that counterintuitive action, is often essential for long-term success and risk control.
Using cash or bonds like a separate warehouse helps with this.
That's one mental trick, yeah. One warehouse for growth, stocks, another for stability and providing cash for living expenses, or for rebalancing buys during downturns. Tax implications are important here, though.
Taxable accounts make rebalancing more complicated.
Definitely. Tax-sheltered accounts like 401k or IRAs have big advantages for compounding and rebalancing without immediate tax hits.
Okay, so let's try and wrap this up. What's the absolute core message you should take away from the 4 pillars of investing?
I think it comes back to that fundamental link. Risk and return. You can't escape it. Higher potential returns always mean higher risk.
And understanding history and our own psychology isn't just interesting background, it's essential.
Absolutely essential.
Yeah.
Because finance is behavioral. The boom and bust cycle isn't gone. It's part of the human condition playing out in markets.
The author's final lesson. High returns come attached to ferocious risk. Expect losses sometimes.
You have to. If you want growth, you will experience drawdowns. The key is having a solid, diversified strategy grounded in these pillars.
And the discipline to stick with it. Fighting your own instincts and the industry noise.
That's it. The market tends to reward those who have a plan and the fortitude to see it through, especially when things get scary.
Which leaves us with maybe one final thought for you to consider, building on all this.
Yeah.
If these principles, risk and return, history cycles, or predictable biases, the industry's conflicts, if they're also, well, relatively clear, why is it still so incredibly hard for so many people to just follow a simple, effective, low-cost strategy?
That is the fascinating question, isn't it? Why is simple so hard in practice? Something definitely worth mulling over.
Absolutely. Well, thank you for joining us for this book talk today. We really hope this discussion helps you feel a bit more grounded, maybe more confident as you navigate your own investing path.
Yeah, hopefully it provides a useful framework. There's always more to learn.
For more discussion and talks just like this one, please do subscribe to the channel.
And we'll see you next time.